Hello, this is My Time Television. We're continuing our review of Southern Fried Chicken. Recently, as the market has gone up a lot, the number of stocks going up has also increased. If you look at the screen in front of you, you'll see that the S&P score has returned to the 60-point range. When you actually enter the buy zone, you should start this corner and keep your buying speed fast until you reach the distribution zone. In the distribution zone, don't be too greedy and you should start selling your stocks. And that's what I'm saying. After that, looking at the index, there was an increase of about 12 to 13%, and individually there are quite a few stocks that are currently on the rise. So in May, it's very difficult to expect as strong an increase in the index as we saw in April. If you look at the strengths of Daehan, despite having made a lot of actual announcements in various industries, it hasn't been reflected much. In May, if we receive additional index adjustments, I think there will be more opportunities to buy at a reasonable price. So I think it's better to be a bit more cautious and buy gradually rather than rushing in. First of all, in the short term, rather than chasing after stocks that have surged during this recent rally, I think it's better to focus on companies that have shown solid earnings in the first quarter. If there is a slight correction in May, that could be a good opportunity to buy these solid companies at a better price. The United States and China have resumed negotiations related to tariffs, and as we head into the weekend, I think this week will be the most important week for the market. If those issues are resolved, semiconductor-related industries and pressured sectors could rebound significantly. Those companies could rise considerably, potentially improving overall market sentiment. When it's difficult to predict the future of the original theme stocks, I think it's best to respond to the market as it unfolds, one step at a time. So, I think it's good to keep in mind that there could be such changes this week and to take a closer look at the analysis of companies or investment strategies. Today, the company I will be reviewing in the shipbuilding and marine sector is Daehan Shipbuilding, which is traded on the Korea Securities Dealers Automated Quotations. Let's take a look together. The Trade Desk is a company that creates digital advertising platforms. So as you know, a lot of advertising has moved from traditional offline ads to the online advertising market. Especially in the media market, the online advertising market is becoming much more active. So the Trade Desk is a company that efficiently manages online ads, delivers them to the right places, and connects advertisers with various channels to achieve better results. In short, it's a company that provides a platform for online ad transactions. In the United States, from 2023 through Q4 and into 2024, advertising expenses rose significantly due to major events like the presidential campaign. Consequently, companies related to online advertising performed quite well. And then, after the presidential election ended, there were some concerns and uncertainties, and the stock prices dropped quite a bit. Trade Desk and other advertising platforms have experienced significant stock price declines. However, their actual performance seems decent, making them worth a closer examination. Among the companies I personally checked, it was one of the industries whose stock price had fallen the most. For Trade Desk, compared to its peak, the stock price dropped by about 69%, which is roughly 70%, so it's almost a 70-80% drop from its highest point. If you just look at the drop, it seems like a lot. It dropped sharply in a short period of time, and when stocks fall, they tend to fall even more. Even after the actual earnings were announced, the results weren't that bad, but the stock still dropped more than 20%. So, it experienced a pretty big and sharp decline. And last week, there was the first quarter earnings announcement for Trade Desk, and those results were actually a bit better than expected, or at least better than what the market was expecting. The market ended last Friday with a sharp drop, but surprisingly the stock rebounded by about 18% and showed a strong upward trend again. Originally it was up by about 20%, but as there was some selling, the increase slowed down, and that was the situation. So I wonder if this industry can continue to grow even more in the future. From this perspective, I think it would be good to keep an eye on the actual changes in the data. It's an excellent company, scoring 77 points and ranking in the top 3% of all United States companies based on its performance. This is clear. But as shown here, the future growth score is only 40 points, which is quite low. This score can be seen as a risk for this company. That's why a lot of people buy it during this period, but when the actual earnings surprise comes out in the first quarter, you should be a bit cautious about this part. The company is good, but the stock price has fallen significantly. However, the first quarter results have somewhat alleviated concerns about the actual performance given the lower stock price. From this perspective, it seems positive. Institutional and foreign investors, who once held 70–80% of the outstanding shares, have recently significantly decreased their holdings in the stock despite previously leading and holding it. For example, let's say you enter the data once a month, but if the actual correction is lower, it means the gap has widened a lot. Nevertheless, in the most recent quarter, the actual results announced last week showed that sales dropped by 6.1 billion won, which is a 25% decrease compared to the same period last year. And the net profit for the same period was 0.1 billion won, which is a 66% decrease compared to last year. So, if this year's expected sales are 16.7 and the earnings per share is 8.7, that's actually quite good compared to that. So, it seems that the consensus data that was expected by the market is also being adjusted little by little to match this. So, let's listen to how this adjustment will continue in the beginning and see what various people have to say. Since you can view all this data for free, let's check it out together. Whether the trade desk continues to show growth, in the end, the most important point is whether it can recover the company's main value. Boyodran's market outlook for the first half of the year surprised me. The company's operating profit margin has improved significantly, reaching around 17% compared to just 7% about 2 or 3 years ago. With a 10 percentage point increase, the company is currently demonstrating quite good profitability, which is how it should be viewed. Looking at the stock price and the order of market capitalization, the ranking has recently risen a bit, but it's rare for the stock price to go up this much, while the market cap ranking also jumps like this. Stock price doesn't always follow earnings per share exactly in the long run, as seen in the limited examples, and the stock price and earnings per share chart from a retrospective view. So the important thing is to figure out what the momentum for this rise is, and to determine what is causing it. In cases like the trade desk, there were some concerns about growth, but as soon as the first quarter earnings surprise came out, those concerns were immediately reflected in the stock price rankings, and you could see the stock price jumping up right away. Despite many analysts noting rising stock prices and earnings per share in various industries, valuations remain high. The stock price is staying low due to a core issue. If that issue is resolved, the price can immediately rise. It's not that difficult to understand. Yonhansan's market share is 4.1 trillion won, but if you look at the actual business performance, it's 8.4 trillion won, which is about double. If you look at it that way, apart from other business activities, there were a lot of cash flows in reality, but there were also parts that were clearly shown as non-cash items. The difference is about $400 million, and these parts are ultimately non-cash items. Or, on the books, it was processed as a loss or as an expense, but in reality, there was no actual cash outflow. These kinds of costs are included. So, from a long-term perspective, if you look at pure profit, the ability to generate actual cash flow is high, so the quality of profit is also very high. As mentioned, I made a forecast for Juga's earnings per share chart. Let's review it together. The stock price fluctuated significantly because the front part in green represents the confirmed earnings per share, while the dotted line in the back shows the expected earnings per share forecast. The industry's stock price ultimately follows its future performance. The stock has fallen about 70% from its peak, partly because earnings per share is expected to rise again in 2025. If you look at the dotted line, it's very low, it's very flat. And the reason for that is because when the earnings per share growth rate was reflected earlier, it was about 8% per year. But since then, when it was expected to grow rapidly, the stock price rose significantly. But since the growth rate is low, the stock price is adjusted accordingly, and the growth rate itself hasn't improved, so there's a concern. That's why the stock price has dropped a lot and has been undervalued for quite some time. But after that, the current price already reflects this year's expected actual net profit growth rate, so it's dropped to a level that already takes that into account. So people were waiting for momentum, but when the surprise came out, it was quite shocking. And after that, if you look at the data for 2026 and 2027, the expected growth rate is even lower. The growth rate can be seen more accurately in the data, but going forward, it's not just a single-digit growth rate, but it looks like the growth rate will recover a bit more. That's how you should see it. So, if you look at the sales growth rate, this year it's 28.5 trillion won, about 16% next year, about 19% and 17% the year after that. At this level, the sales growth rate is quite solid. The current earnings per share growth rate stands at 8%. This part is because last year, due to the drop in stock prices, the growth was only about 8%. At that time, the stock price was at a relatively low level, but now that momentum is coming back, so the stock price is entering a relatively steep upward phase. The part we need to pay attention to is 2026 and 2027. At that time, growth rates of around 35% and 32% are expected. So just looking at the growth rate, 2026 and 2027 look quite promising. So from an investor's perspective, the market's attention is shifting from 2025 to 2026. Usually, contracts are made for the following year. So if the settlement is in December, by around August or September, the actual results for that year are not reflected yet. Instead, the actual results for the next year and the year after start to affect the stock price. Stocks with only 8% growth have performed poorly because the market is already reflecting the situation expected in mid-May, causing the stock price to react this way. Now you should look at the reactions of stocks that are growing even more, and then observe the changes in their growth, and next how the earnings per share growth forecasts are changing. Since these figures are continuously updated and provided by Choice Stock, it would be good for many people to check them out. If you scan the barcode, the Trader Desk's November 2024 chart shows that the area is colored in red, which means that the valuation is stretched. Undervalued stocks rose to overvalued levels, but after adjustments, the stock price performance was lackluster. The actual performance wasn't worse than expected, but because the guidance was slightly lower than the consensus, people said the expected performance was down, so the stock price dropped by about 20%. Following the steep decline, a rebound was expected, but actual earnings resumed falling. When the S&P index drops 15%, stock prices plummet, becoming undervalued. After shifting from overvalued to undervalued, the announcement of actual earnings leads to further downgrades. Currently, it's undervalued, but still within a reasonable range. So, in industries like this, there are often cases where the stock is very undervalued right now, or at least at a slightly undervalued level, so you can expect some growth and a bit of a rebound in the future. That's the kind of pattern you often see, so I think it's worth considering cautiously. Right now, I don't recommend buying it immediately. By sector, there are currently about 16 stocks that are at or near their lowest point. So just because this industry is at a low right now, it doesn't mean you should buy all of them or rush in to buy everything. Compare each stock carefully and select them well to build a good portfolio. That way you'll likely succeed. Looking at the chart, you can see that I am showing both the short-term and mid-term charts. So if you check it on the site, I think it will be helpful. I have launched the app. Android and iPhone apps are available for downloading to receive notifications and information on various popular topics. After Dead Cross occurred, until now it was Dead Cross, but recently a Golden Cross happened, so it's good that it has turned into a momentum trend. Now you can see it in this form. I moved to this site, so I checked the trade desk to the very end, and I also checked the parts that needed to be checked as much as possible. The trade desk was holding the buy signal, but as soon as the buy signal appeared, the actual price didn't reach the target level. So even though the buy signal was there, it was impossible to actually enter at the target price. There was nothing we could do about this kind of sharp drop, but after that it rebounded and now it's coming back up again like this. Right now, it's just in a sideways trend, but if the price holds at this level today and tomorrow, there's still a possibility that the artificial intelligence trading system could turn to a buy signal. And if you look at this part like this, you can check one by one how the scores have changed compared to last year, such as growth, independence, financial soundness, stability, and profitability. So you can check not only for this industry, but also for other industries, whether things have improved compared to last year or not. Next is this exponential moving average chart indicator. The 5-day moving average has crossed below the 21-day line, but the 21-day line is still above the 61-day line. As long as the main price remains above the 71-day line, even with some adjustments if it holds, all other chart moving averages may change direction. If you look at the midterm chart, what we call midterm is a pattern that looks at things over a longer period. So if you look here, in reality, even though Shinho has been holding on with me until now, in the midterm there haven't been any clear upward trends. Instead, there have been some short-term rebounds when it falls, but that's about it. So I think it would be good to refer to these parts when making your decisions. Please check the earnings per share chart for the main stock, and as I mentioned earlier, the data is here. Since it's here, let's listen to it separately and see if the data is improving or recovering. I think 2025 will be even more important. As for 2026, since the current outlook is good, Let's see if the earnings per share and sales growth here continue to improve steadily. If it goes that way, the trade test could recover even faster. If the second half continues to show real improvement here, the stock price might not fall. I think it would be good if we refer to data in that form and make final judgments together. With this, I will wrap up the review of Trade Desk. Please subscribe, like, support, and comment if this was helpful. Thanks.